Okay, I'm just going to do a quick run through of the weekly open Furquid for you, just so you get an idea. It's a bit easier to explain in a video than it is over email or a text. Basically, what I was saying, let's get see the cursor on the screen there. So you've got the first bar of the week there. That obviously is always going to touch the weekly open. So we can go shorts below and longs above. Whichever triggers first, the opposite entry will be cancelled and used as the stop loss for the active trade. So in this instance, I'll just run through what happened for me on Euro. I was a bit lazy. I didn't get to the charts about 8 o'clock or something on Monday morning, so I missed this long entry up here. Price was back below the high, so I was still in a situation where it was an each way trade for me. Could have gone long or short. As it happened, it triggered short down there, so I'm now short of that. My stop loss is, let's just colour these just like that. So my stop loss is now at the high of this bar, entry below it, so we're short. Traders triggered there, moved back up against me, closed. So this next bar that closes it completes, that touches the weekly open. So that is now classed as a trigger bar, and that can be used now for new trade entries or trade management. So in this instance, there's nothing to do with the stop loss. There's no management to be done there, because the potential stop loss on there would be at the high of this second bar that touches the weekly open. So I'm currently short, so I'm just waiting for either the short trade to hit targets or get stopped out, and I can now also place a pending long entry at the high of this bar, because that's a new trigger bar. So as it happens, you can see that the short trade got stopped out on that bar where the cursor is now. So I've got no, I'm all flat now. I've got no open trades, and all I've got is a long entry waiting to be triggered, which is up there. So that didn't trigger. Now on completion of this next bar, which for me was the 10 o'clock bar, obviously I wouldn't have been at the screen at that time, but that's also touching the weekly open. So as I'm all flat and that bar hasn't triggered a long, I can now also use that for a new short entry. So the way things looked there, a bit rid of that arrow for you. The way things looked, we've now got a pending long entry off there and a pending short entry from that bar there. Neither of them have triggered. The long entry would have been above 39.52, so doing the usual stuff, plus 2, plus a spread rounded up, it's going to be 39.60. That was 55.5. That was 59, so we're still not in there. And we would have been triggered long on this bar here. So we can cancel the short entry. Let's remove that. There is our stop loss. We're below that bar. So we can adjust it, because we've got another bar there that touches the weekly open. That can be used for new trade entries or trade management on existing trades. So we can move the stop loss up from the low of the trigger bar to the low of that bar there. Now the way this would work, once the trade is triggered up there, it's triggered long, price is above the weekly open. Any subsequent bars that complete as a bearish bar can be used for trade management. So for example, let's say, oh no it isn't, but let's say this bar here is a bearish bar. Well, this trade triggers, and then we could then use the low of that bar there for trade management if it was a bearish bar. As we stand now, we're triggered long on, let's put a mark on it, trigger long on that bar, and our stop loss is still below the last bar to touch the weekly open. So basically, just class anything that touches a weekly open can either be used for trade management on existing open trades, or it can also be used for new trades, which is what's happened in this instance. Now, remember when I was telling you about the trades, things usually either happen on usually hit targets on a Monday, Tuesday, in which case the rest of the week will be just classed as a retracement. Or if you don't hit targets on a Monday or Tuesday, you tend to find, or I found, the price will wander around sideways and maybe get you in and stop you out on a couple of attempts before sort of Thursday, Friday time, at which point it would go on to hit targets, or it has done in the past. There's no guarantee that it will carry on doing that, but that's just the example. So hopefully that clears it up for you. So first bar of the week touches a weekly open, long above, short below. Whichever triggers first, the opposite entry gets cancelled and uses the stop loss. Any new bar that touches the weekly open can be used as trade management for the existing trade, and also to place a new pending order in the opposite direction. So that's basically how the ideal bars, the classes. If you read Phil's article, they are classed as ideal bars. They're called trigger bars, or just a bar that touches a weekly open, whatever. So essentially, that's the way they work. If you're still a little bit confused about life, I've not explained it properly, just drop me an email, let me know, and I'll try and run through it a bit clearer for you. All right, buddy. Cheers. Speak to you later.